Good afternoon, this is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 4th, 2016, featuring Update Analytics. We'll primarily incorporate data from the Update Energy feed, Baker Hughes, and CME Group NYMEX. We'll break down the report according to the 5 regions that EIA reports on each week. Beginning from left to right, we'll start with Pacific region, then Mountain, Midwest, East, South Central, and then we'll look at the overall 48 United States. Highlights from this week's report: 152 BCF drawdown, basis differentials in the regions are widening, we're at an all-time record low total rig count, and we've resumed the negative trend. Let's go to the charts. Beginning with the Pacific region, all the charts are constructed the same. The heavy blue line is the gas and storage, the black dashed line is the 5-year average of gas and storage, the light green dashed line is the 5-year average maximum, and the light red dashed line is the 5-year average minimum. In the center pane, we look at the amount of gas and storage changes each week, be either positive for an injection or negative for a drawdown. And then in the bottom pane, we take the difference between the natural gas and storage and the 5-year average to determine whether we have a surplus or a deficit. Looking at Pacific region this week, 271 BCF in storage, well above the 5-year average of 247, and just slightly below the 5-year average maximum of 277. After a 2 BCF drawdown in the center pane, there's a 24 BCF surplus in the Pacific region. We also take a look at the delivery points within the various regions. In the West, we look at PG&E and then the SoCal basis. And you can see the SoCal basis, the basis differential has declined somewhat, and it's relatively stable and still trading at a discount for SoCal. Mountain region, slightly above the 5-year average maximum at 159 BCF, or slightly above the 5-year average at 159 BCF, following a 5 BCF drawdown and just a very slight 8 BCF surplus in the mountain region. Looking at the delivery points, we've got the Rockies and then San Juan. Both of those are trading at a deep discount. In the Midwest, 767 BCF is right at the 5-year average maximum and well above the 5-year average after the 44 BCF drawdown, and the surplus in the Midwest region has expanded again this week up to 123 BCF. 2 delivery points that we cover in the Midwest region, Chicago and Michigan, both of those are at a premium, but you can see that that's been steadily backing off through last year and this. Into the eastern region, 641 BCF puts us just slightly below the 5-year average maximum, well above the 5-year average. A 54 BCF drawdown, so very substantial, and that helped work off the surplus down to just 71 BCF in the east. 3 delivery points in the east. 2 of them deep discounts, and you can see the Transco Zone 6 has worked itself from nearly $4 at the end of 2015 to now less than 50 cents here in the early part of 2016. South Central region, this is what we most commonly equate with what was formerly known as producing region. This includes Texas and Oklahoma. Still more than 1 trillion cubic feet of gas and storage in this region, well above the 5-year average maximum. A 47 BCF drawdown this week helps keep the surplus stable at 218 BCF. Not surprisingly, all delivery points in the South Central region are trading at discounts. Over to the lower 48 United States, we are just now under 3 trillion cubic feet of gas and storage at our 5-year average maximum. You can see in the center pane the 152 BCF drawdown we mentioned at the top of the report, and the surplus here is very nearly stable at 445 BCF. Looking at exploration and production activity, this is the Baker Hughes rig count for North America. So this is all land rigs in North America, those focused on exploring for natural gas and for crude oil. We're at 590. And I've put the brown dashed line here all the way back, and it intersects the rig count back in 1999. So this is the lowest we've been this century, and it looks like we're appearing to like we're going to trend down and may even threaten this 392, which is the all-time low for the Baker Hughes North American rig count. Looking at rotary rigs focused on natural gas from Baker Hughes. This is rotary rigs in the United States only looking for natural gas. And you see the 242 we've got over there on the right side, the red dash line. That is the all-time historical low for this statistic. And you can see we're well below that 121 rotary rigs focused on natural gas. Over to natural gas pricing. First thing we'll do is take a look at the seasonality. Top pane is the Henry Hub natural gas futures from NYMEX. This is data comes to you via e-signal, and what I've done is in the bottom pane we've placed the 10-year weighted average of annual seasonality, and I've done some highlights here. You can see that once we move into April or so, we'll have a time of seasonal strength, but for now we've got seasonal weakness or seasonal volatility, however you care to view that there in the bottom chart. But in either case, nothing that really helps support natural gas prices during this time of the year. Over to the daily chart. This is a daily cloud chart. I've emailed this out a couple of times when I was in the field and wasn't able to do the video reports. One thing that I'd highlighted earlier was we had this huge rebound in the end of 2015. It actually took the price above the cloud spans and just momentarily took the lagging line up there. But this is something that you'll see people that use these charts. I know Chris Hyde views this as well, and David certainly uses cloud charts, given that he's the subject matter expert on the topic when he does charts this week. The lagging line never broke convincingly above there and remained. We reverse back down, and you can see the price has really been working its way rather sloppily down this cloud span, and we do continue this downtrend. For the day, we're down a little over 3%. Over to the 60-minute point and figure chart, working well below this bearish resistance line that we've been below for some time. That was set a couple of weeks ago, and then we went through this consolidation here and then broke down right before the report this morning. Over to the 15-minute chart. This is the actual futures. This is NGH6, so this is March Henry Hub natural gas futures. We were right here around right around $2, and then ever since we reported the 152 BCF drawdown, sold pretty much straight down, recovering just slightly here this afternoon. Take a look at the forward curve. This data comes to you from the updated energy feed. So this is the NYMEX forward curve for Henry Hub natural gas futures. When you go back and look 5 days ago, you can see that pretty much at every delivery we've shifted down. So the downtrend still remains in place, and this shift in the curve is also consistent with the ample supplies of natural gas and the discounts in the basis differentials. This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 4th, 2016. Thank you very much for joining us. And if you have questions or comments, please feel free to contact me directly. If you have questions about Update Analytics, please reach out to their sales team. Thank you, and have a good weekend.